Today we're covering the Earned Income Tax Credit, often abbreviated as EITC, a critical topic for the enrolled agent exam. This is the largest refundable credit, which means a taxpayer can get money back even if their tax liability is zero. For the 2025 tax year, the exam will expect you to know the maximum credit amounts. The credit is $649 for a taxpayer with no qualifying children. It jumps to $4,328 for one child, $7,152 for two children, and tops out at $8,046 for three or more children. The exam tests your understanding of three main hurdles to claim this credit: earned income limits, adjusted gross income limits, and the investment income limit. Earned income is money from working, like wages on a W-2 or net earnings from self-employment on a Schedule C. It does not include interest, dividends, pensions, or unemployment compensation. The AGI limit is a separate test, and both the earned income and the AGI must be below the threshold for the taxpayer's filing status and number of children. A major trap on the exam is the investment income limitation. For 2025, the taxpayer is disqualified from the EITC if their investment income exceeds $11,950. This is not a phase-out, it is a hard cliff. A test question might present a scenario where a taxpayer meets all other qualifications, but has $11,951 in capital gains. In that case, they get zero EITC. Be vigilant for this specific detail. To claim the higher credit amounts, a taxpayer must have a qualifying child, which involves passing 4 specific tests. A great way to remember these is the phrase "really awesome relatives jump," which stands for relationship, age, residency, and joint return. For the relationship test, the child must be a son, daughter, stepchild, foster child, sibling, or a descendant of any of them, like a grandchild. For the age test, the child must be under 19 at the end of the year, or under 24 if they are a full-time student for at least 5 months of the year. A child who is permanently and totally disabled meets the age test regardless of their actual age. The residency test requires the child to have lived with the taxpayer in the United States for more than half of the year. Finally, the joint return test states the child cannot have filed a joint return with their spouse for the tax year, unless they filed it only to claim a refund of withheld taxes. Taxpayers without a qualifying child can still claim the smaller EITC. However, the exam will test the special rules for them. The taxpayer must be at least 25 years old but under 65 at the end of the year. If they are married filing jointly, at least one spouse must meet this age requirement. They also must live in the United States for more than half the year and cannot be claimed as a dependent by another person. The exam frequently uses scenarios to test these rules, so memorizing the tests for a qualifying child and the specific age bracket for those without a child is essential for earning points on this topic.